Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. And today I just wanted to talk about kind of a overhead bird's eye view of what's going on in the market right now. I want to get more into some of the hysteria that is absolutely driving me crazy right now in the marketplace and what's going on with basically the mainstream media trying to get their clickbait as usual. And I think it's important to kind of explain that, kind of drive that home and really dig into the numbers. This is going to be kind of a bigger national view of things, do a little bit of the Phoenix info, but mainly overall the housing market and what is actually going on. And then I will be doing a regular weekly market update, of course, this week, so keep an eye out for that. Also giving you some information on rental market and stuff like that. I just want to make sure that we cover this because it is one thing that just drives me insane. So the mainstream media is confusing the consumer because their job is to, these days, get you to click on stuff. So, if they put up housing market imbalance, is that really going to be, news that somebody's going to click on? Probably not. What's going to create more clicks is the housing market is crashing, we're in a recession, da 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 da. So let's get into the actual economics of how this all works in as much detail as I think that'll take to kind of explain this a little bit more and then go from there. Now, obviously, I don't have a crystal ball. Obviously, disclaimer, I'm not an economist. I am a realtor, and my wife Cynthia and I have a real estate team. She's also a loan officer, so is our son, and we've been in the business now about 10 years. And we've kind of also been through the housing market crash with doing our own home purchases and sales even prior to being in the business. So we understand the concerns here with that, but we've got to really dig into this and see exactly what's going on and what's not going on. So inflation drives mortgage rates. Okay, inflation drives mortgage rates. What does that mean? Well, basically, we had from 20 and 2022, these were anomaly years. They were anomaly years. Think of it like this: if you owned a home, you were basically getting a housing lottery. Okay, now how often do you win the lottery? Not very often, right? For most people, I don't know. I know there's people maybe hit it more than once, but it's not something that we hit on a daily basis, right? So with this last couple of years with the pandemic, we had the Fed coming in with money, keeping the economy going, and we had demand go up and supply was down. Okay, supply was down. And this made prices rise. That inflationary factor went into, one of the things that went into was the housing market. So then we had the 2022 time period where we have demand destruction now, where prices have gone up so much that now the Fed wants to come in, raise interest rates, bring the demand more in balance with the supply, and the supply in balance with the demand, okay, which in the Phoenix area, we're pretty much there, okay, in a balanced market, not a crazy insanity market. Now, national average is usually maybe 2, 3, possibly 4%, about 2 to 3% though in equity gains per year. In the Phoenix area, in the Phoenix metropolitan area, our equity gains are usually a little bit higher than the national average. Ours is going to be more around 4.5 to 6% typically. Sometimes maybe 7% in certain areas of town. It may be a little bit higher than others. But the fact is right now we're really more in a balanced market across the board in the country. And we certainly are seeing that not only anecdotally, but the numbers drive this home in the Phoenix area. So prices, of course, not the actual appraised value of the home you own, but the influx of supply that we're seeing and the drop in demand due to the factors of, people aren't migrating due to mandates. Yes, the interest rate has a little bit to do with that and the higher prices, but guess what? We know that if someone needs to buy a house, they're going to buy a house. They have to have a place to live. They're going to pay a mortgage no matter what, unless they're living in their mom's basement. So guess what? That means that, they're either going to pay rent and throw money out the window, or they're going to get a mortgage. They're going to buy down that mortgage. They're going to increase their equity, at least conservatively in the Phoenix area. Again, about probably a 4.5% to 6%, somewhere in that range, typically is the historical average. And then nationally, probably more like 2 to 3%. Okay, those are very conservative, balanced numbers. And this year in Phoenix, we'll probably see around 7% due to the slowdown. Okay, and it's the slowdown in going to a balanced market. It's kind of like we hit the lottery and we thought, well, why am I not hitting the lottery every month and every year? It doesn't work like that. Okay, it doesn't work like that. So we had these anomaly years, and now we have the Fed bringing everything into balance as far as these rates are concerned. And we're seeing that the rates are actually sort of slowing down themselves, but that's a whole nother discussion that we'll touch on and get into in this and other places. So the inflation drives the mortgage rate. The inflation drives the mortgage rate. The inflation drives the mortgage rate. So when inflation drives the mortgage rate, we can see over the history, going back to the 70s, how this works and ebbs and flows during the inflationary periods and recessions and housing booms and so on. Over a 30-year mortgage, what that inflation rate does to the interest rate. Because when the inflation rate goes up, the Feds raise the interest rate to slow things down due to those factors. So, when we look at the inflation, again, inflation driving the mortgage rates and what's happened in history and the people involved, here's a quick chart of that. I'm not going to go into driving these home, but you can kind of see the history of this and how the Fed steps in. It's just the way the economy works, whether you agree with it or not. It's the way the numbers work. We have inflation, back in the 70s, they raised the interest rate. We had it during the time of Alan Greenspan back in the 80s, and the 90s. We have these other factors that were in the housing, or I'm sorry, in the internet debacle that we had back in the 90s. We have the same thing happen then. And now with Jerome Powell or the Feds coming into doing the same thing. So this is nothing new. It's how the economy works. Inflation goes up, and then they raise interest rates. Now, in a bad economy, we'll also see in a bad economy, quote unquote bad economy, we'll see that the interest rates eventually, even in a recession, in a bad economy, that eventually those rates will come back down in order to kind of fluctuate things back into balance the other way, so that we don't have a too slow of a period on these factors for affordability. So the chance of a recession historically is what equals when unemployment is below 4%, okay, and inflation is above 5%, okay. We see that these are the percentages, and the what equals the idea that we're probably going to go into a recession. And that's exactly where we are now. So this is no surprise. It's happened over and over and over and over and over again. Dave Ramsey has gone through this in a recent video where he talks about we're not in a housing crash. We're not in a housing crash. We're not in a housing crash. Okay, we're in a balanced market. We kind of got into, la la land, or, a drunken state, like with our lottery money. But the mainstream media has been wrong time and time and time again when it comes to this. And I'm going to prove it to you. But a couple of things here quickly first that I want to go through is the housing, some facts. The housing stays strong through recessions. And here's a chart showing that and the history of that, so that you can see through the recessions, except for one point. And this is, but 2008. Yes, because that particular recession, that one was caused due to the housing market itself, because of poor lending practices, which we do not have any longer. Okay, used to be able to fog a mirror, not have to prove income, all this stuff, and you can go buy 2 or 3 houses. Okay, there's a whole movie about this, The Big Short. Watch it; it's great stuff. But in any case, that was the reason for that recession in 2008, was because of that crash. Now we're not seeing homes, any strong numbers in foreclosures or short sales going on or anything like that. And there are other factors that we would see prior to this that would cause this sort of thing. But here's what the media tried to do, time and time again. And here's just going back a few years. We could go back further and see it, but especially, the last few years, trying to put fear into the housing market. Okay. But here's the facts. Again, October 2015, housing today, a bubble larger than 2006. And we see the appreciation went up 5.1. Again, this is nationally. So what does that mean? 5.1% appreciation. That means the amount was on a $300,000 home, went up $15,000. So if you listened to them, you would have lost out on, again, these are using average numbers in the housing prices in America at the time of 2015. You would have lost out on $15,000 on that $300,000 house. August 2016, we're in a new housing bubble. We're in a new housing bubble. The media is talking about this. We're in a new housing bubble. Guess what? That year, appreciation went up 5.4%, which was $17,000 on the average price home, which means you were at $332,000. Again, using the average numbers at the time. November 2017, home ownership doesn't build wealth, study finds. Well, that's kind of funny because studies have found that it actually does build wealth. It's kind of the number one way people do build wealth in America. It's right up there as one of the number one ways they do build wealth and pass on wealth to their kids. So, we look at this in 2017, November 2017. Again, appreciation was 6.1%. That means you went up 20 grand. That means you were at 354,000. September 2018. It's better to rent than to buy in today's housing market. Went up how much? 4.1%. That year, that means 14 grand. Again, this is nationally average, using round numbers, $367,000. July 2019, the media, the mainstream media, I call it the lamestream media, because if they ever did anything in the business world, in the true business world or economics for themselves, they'd find out the hard way it's not the way they think it is. But the housing market is about to shift in a bad way for buyers. It went up 4% that year at $15,000. That puts you at $382,000. Okay, so we started at $300,000. Now we're at $382,000. December 2019. Next year, see, every year it's going up. Every year it's going up, right? Next year will be hard on the housing market, especially in these big cities. Went up 16% in 2019. 2019, that was before the pandemic. 16%, that was $61,000. That gets you $443,000. July 2021. Housing boom is over as new home sales fall to pandemic low. 18% in 2021. That was an $80,000 increase, and that puts you at $523,000. Now, I know that there's been people sitting on the sidelines almost since the last crash, if not since the last crash, waiting for the next crash before they buy. Or at least that's what they say. But that's why they're doing it. In their mind, they're saying, I'm waiting for the next crash. Guess what? Not happening. Not happening. The amount of equity people have today, the difference in lending practices that people have today, unless our government goes as crazier than it already has, and takes away everybody's properties for some reason that I'm missing, guess what? We're not going to have that issue with the lending practices we have today. Ask anybody who's bought a home recently the hoops they had to jump through, and rightly so. We want to make sure that they can afford that home. We want to make sure if it has an HOA, they can afford that HOA with the home or that solar lease and so on. So it's important that we put facts on the table. And when you hear Uncle Bob and this one and that one in the media say, well, the housing market's going to crash, they say, who's they? These same people here, if you waited all this time during these last 7 years, look how much money you've lost. From $300,000, you've lost what? $223,000 for listening to people you don't even know. All right? Get the facts from the people who know, that are in the business. I know people think, oh, you're just trying to make us. Guess what? The better you do, the better we do, and vice versa. So it's kind of works hand in hand, and both hands wash the face when it comes to real estate, guys. Housing economics. High demand and low supply equal higher prices. Low demand and high supply equal lower prices. Now, you guys, I'm sure everybody understands this, but it just needs to be said because we keep hearing this nonsense over and over again. Demand and supply are equal, and they equal sustainable appreciation. All right. So, housing economics and demand. Rates are irrelevant. Rates are irrelevant. Why? Because if someone is really in need of buying a house, they have to have a place to live. So they're either going to pay a rent or they're going to pay to buy, right? One or the other. So, and with the way rents have skyrocketed, I'll do a separate video on that. But the way rents have skyrocketed, it only makes sense to get the tax advantages, buy down your mortgage, get this appreciation that I'm showing you here, even if it's the modest years of appreciation. And again, in the Phoenix area, you could probably figure on about 5% conservatively, and that's the way it'll be. And we've got a very strong housing market. We've got a very, very strong economy here too. So, guys, but nationally, housing demand is created by household formations, families in need of buying a house. Okay, two people come together and they want to buy a house. Okay, so that's kind of how that goes and what drives that in the market, what drives the market itself. And rates are irrelevant. Housing economics and supply. We talked about demand. Now let's talk about supply. New housing supply. Okay. Housing startups at 1.7 million right now. Destroyed annually, we have about 100,000 homes that are destroyed annually. And keep this in mind, new housing supply, that means not necessarily your resale, but your brand new homes coming on the market. Brand new homes coming on the market, not resale, brand new homes. Because usually, not always, but a lot of times people are selling a house, but they're also buying a house. So that kind of cancels it out, right? So we're talking about new homes, I'm talking about new homes. So new housing demand, household formations of 1.4 million, the apparent surplus is 200,000. Housing startups complete, okay, so if we break this down, housing starts completed 1.3 million, destroyed annually 100,000. Total new supply is 1.2 million. Household formations, that means two people coming together need to have a house, okay, need to have a place to live, is 1.4 million. That is an actual deficit of 200,000. 200,000. Now, for the crash, these numbers for housing startups were much higher. They were triple these numbers, okay? Triple these numbers. In the Phoenix area, we had, when the crash happened, we had right around 56,000 homes on the market. Today, right now, just checking the MLS, we've got about 18,000, okay? And again, I'll do a separate housing market video for the week, but in that video, we'll see the Cromford Market Index and where we are on the actual supply and, in demand, and we're right near balance. So guys, we're just in a neutral or balanced market now. We're in a normal market. That's a good thing. That's a good thing, okay? We won the lottery if we already owned a home, and now for a buyer, we actually get a pretty good deal, but nobody lost the actual appraised value on their home. They just hit the lottery for a couple of years. Okay? So housing economics and inventory, record low inventory. At the peak, during the crash, going back, if you look at this chart, the peak 3.8 1.81 million peak in inventory. Currently, what's that say, guys? 1.3 million. So you had 3.81 million, okay, in 2007, right at the crash, and currently 1.03 million. Okay, inventory is a big thing that drives the market. They had over surplus of homes. Now we don't have enough still. Okay, we don't have enough still. But Chris, things have kind of slowed down. Yeah, we had a lot of FOMO people. We had builders getting caught up. Now they're kind of stepping back. And take a second. In the Phoenix area, we had 55% of people selling their homes in the last couple months. We're second home buyers because we are a vacation spot. We had a lot of people who invested in the last couple years in homes that they were going to rent out or Airbnb, and now they're trying to sell out because they're listening to the media, or they just wanted to make some quick money and get out. And we have the new build. That's about 55% of the market. But a lot of that is also now either being sold off or dropping off. And in my video I'll do for the week, and I'm going to show you, our number of homes coming on the market has actually slowed, and a number of contracts is starting to come back up again. We'll see where that goes, but that could mean, again, a solid balanced market, or it could mean maybe we're going back into a little bit seller's market. And remember, real estate is seasonal. For us here in the Phoenix area, our biggest months are April and May. Okay, so you figure right after the holidays, we get tax season. People want to move when school's out, before it goes back in session. On the East Coast and other places, you guys are back in school in September. We're back in school beginning of August. So, and we have a lot of people who go on vacation in July and August, so it's so hot, and a lot of people go in August even when school's back in, because you have like a lot of mid-level, high-level executives and management business owners go on vacation in August. Why? Kids are back in school here in the Phoenix area, so, and places around the country. So August, September are kind of still in limbo, especially through Labor Day, maybe even a little bit after that, because people are going on those vacations with or without the kids prior to or during those months. But then we have what we call in the business, it kind of sounds nerdy, but we call it Rocktober. Because usually in October and into November, December, prior to the holidays, we have a lot of properties going under contract and closing in November and December because of escrow periods being around 30 to 45 days typically, sometimes up to 60. So it's just the way it kind of cycles, and seasonally also too, guys. So all this kind of, hit at a peak all at once, because for us, especially in our area and other areas, spring, summer was the time where people put their home on the market, and then you had all the FOMO people and all the second homes and investment homes going on the market, plus the builders were starting to catch up a little bit more. So, they were just building spec homes, and it was kind of like that. And then, yeah, the interest rates maybe took out another, percentage there, but it's not the be all end all. Okay, not the be all end all. Affordability is certainly an issue. People are paying 25-30% more for everything when it comes to gas, food, and utilities, and then the housing prices went up, and then the interest rates go up, and then more homes go on the market all at the same time. It's a lot all at once. So that takes 2, 3, 4 months to kind of settle out. So again, we're probably going to see a nice little, like we normally do every year, a little strong, listings under contract, little serious buyers out there towards the end of the year looking, and then right after the holidays, boom, we're pretty much right back into the busy season. But once we start getting into February, March, April, May, it's the way it goes here in the Phoenix area anyway. And in the other areas where your schools are a little different, people are trying to do it maybe a month later. All right, guys. So looking at the active listings count, we're up 18.7% in June. This is June for 2022. If you see the line there in the middle where the writing is, it's actually active listing count was up 18.7% year over year. I know it sounds crazy, right? With all the frenzy from last year, but it actually makes sense because of all the properties that were going on the market and getting eaten up so fast last year with all the migration going on. And the way the rates were at like 3%, it certainly is a factor. So now we have this increase year over year in active listings, okay? And we have housing economics that we need to talk about. Inventory is growing. Inventory is growing, okay, from these charts that we're seeing. And we see existing home inventory. The real story is, again, existing homes in inventory, 1 million under contract, off market, 600,000 active listings, actual inventory of 400,000. Again, this is nationally, okay? Housing economics, but inventory is growing, right? It's growing, like we just saw. So active existing home listings in the U.S. Active existing home listings in the U.S. So we look at this chart and we see, wow, what's happening? We see that we had a drop, and now we're seeing it kind of curve right back up, okay? And in April of 2022, we had 409, that's 40% of the market available, all right? In 2016, we saw 1.5 million of 2 million existing homes in inventory. That's 75% of market availability. Wow. So, guys, what does this mean? Number of households, again, is what drives the market. How many two people come together and they buy a house? There are single people who buy houses too, of course, but typically we see, families buying homes, and because they want the home ownership, the freedom of home ownership. They want to grow their equity. They want to get the tax benefit. They want to buy down the mortgage. So they don't have that payment anymore eventually, and they also want space for their family, right? Kids, dogs, whatever, maybe a yard, and those sorts of things. So those come into play more and more as people come together and they get older, right? So 14 million more households, almost 3 million fewer homes is where what we're talking about compared to now and the crash. So we see housing forecast, median list prices up 16.9% compared to last year in June. Guys, you hit the lottery, okay? You hit the lottery. You're not going to hit the lottery every year, but you're still going to make money off the investment, okay? Off the investment of the lottery money, which is your home, okay? We see it leveling off. Yeah, that's not going to go on forever. We're not going to have 20, 30, 40% equity gains in some places like we had every year. It's not reasonably normal, okay? So year over year though, 16.9% from year over year. When we look at those numbers up to $450,000 now. That's the median list price, okay? Newly listed homes up 4.5% year over year, taking the numbers from June 2022. We see those numbers are up in June. That's 562,000 and some change. That's up 4.5% year over year. Okay, newly listed homes. Okay, again, more of a normal market. Got kind of a little bit lower demand, a little bit more inventory, and we get to balance. Active listing count up 18.7% year over year. Okay. I don't want to spend too much time on these, but the pending list price, this is very important because this shows us how many people are in the market right now. And we saw, again, a little bit of a leveling off like we would expect this time of year, going into things, especially in the Phoenix area. Again, our biggest months are going to be April, May. Across the board, maybe a little different, but we still see pending list counts are up down 16.3% year over year, and those have to do with those inflationary and interest rate factors that we were talking about, but also the demand factor that we had talked about earlier. So days on market, super important, down 4 days. What? Down 4 days compared to last year in June. Down 4 days compared to last year in June. So we're at 31, again, this is nationally, 31.5 days on market. 31.5 days on market. All right. Again, that's normal, guys. For a house to take, even 30 days or even a little bit longer to go under contract. That's kind of more of like a balanced market. Think about it. During the height of the insanity here in the Phoenix area anyway, we were at like a half-month supply, 2-week supply. A normal market, a normal completely balanced market for us is really more around 4 to 6 months supply. That means if everything were to sell and nothing else came on the market, okay, if that were to happen, we would have you know, in 4 to 6 months, we would have no other homes to sell. Okay, that's what that means. So, guys, it's important to make sure everything's, you know, within the proper context here, right? So, here's the big thing: we've got price reduced sharing. Why do we have price reductions happening right now with new homes? Usually the new homes are the most expensive in the area, right? In the zip code, right? Typically for homes being put up for sale, unless you're dealing with customers, usually new homes are going to be the most expensive in the area, right? So some of those are having reductions and different incentives. And we're not in the lottery market anymore, right? So there, of course, is going to be a minor adjustment, and the overall average is going to come down. Why? We have more homes on the market. That means we have more homes now under, you know, 500,000, under 400,000, especially in the Phoenix area, just using our kind of numbers here in our area. So that overall average is going to come down. We see more competition when there's more homes on the market, right? There's more options for buyers, okay? So when there's more options for a buyer for any product, that kind of sets prices a little bit more at a level playing field, or where they're competing a little bit more, right? Or, you know, maybe if your home has all the bells and whistles updates, maybe it's got a pool here in the Phoenix area, that's a big deal for a lot of people. Yard's already beautiful, like a resort. Yeah, that home may sell a little bit quicker, you know, with all the updates and fixtures, okay? So keep that in mind, guys. The price reduction share up 7.3% points year over year. Again, that's across the country, okay? So